Good morning, everyone. It is Wednesday, February 18th, 2026. The market is going to open in roughly 30 minutes. And this live stream is going to cover stock analysis, stock investing, stock trading. We will look at fundamentals of stocks, taking a look at how they are performing overall as a business, how their fundamentals look. Do they produce really good free cash flow? How are they valued based on free cash flows? Are they profitable? And if we value that profit, where does that fair price land in context to their current share price? Additionally, we're going to take a look at how these stocks are setting up on the charts. And with me is Daryl. How you doing, Daryl?
Doing wonderful, Victor. It's good to be here. Hello, everyone.
And if you have not attended, Daryl handles the technical analysis, does an awesome job. We'll get to that piece of it. We had a couple stocks in mind. All three announced recently, if not today or yesterday. Analog Devices announced this morning before the market is opening. We're going to take a look at Analog Devices. We're going to look at Medtronic, which is a med device company, and they announced yesterday. We're going to also look at GMAB, which is GMAB. That's a small cap healthcare company. And I'm not sure when they announced, either yesterday or Friday, but that's a stock we've looked at a few times. We're going to take a look at that one. We'd love to look at stocks that you're interested in. If you're a member, just put it in the chat. We will take a look at it. If you're not a member, no big deal. You could pay a $5 super chat and we will take a look at your stock and we'll go from there. So we are headed toward a slightly positive open with all three indexes headed toward a positive open. The last month or so, the market has worked for some sectors and really not for others. If we look at staples have been working quite well, energy, materials, most definitely, man. If you were in silver over the last year, you're doing great. Utilities are doing well. Industrials are doing well. Pharmaceuticals doing well. Biotech's doing well. But there are some sectors like software that are just getting beat up. Microsoft getting sold off. Amazon sold off. So there's opportunity. This is good news to me. This is, hey, you can give me good prices. I'm open to buy stocks when you price them really well. Then when those businesses go back to their intrinsic value, I make money. So overall, this is where we're at. Year to date, any observations or what's worked for you, Daryl?
Real estate has been the biggest performer for me.
Yep. And lower interest rates. And I was in the gym and I glanced and saw that home starts went up. Is that correct today? They were announced, excuse me.
I haven't looked at that. It's one that I'm going to be watching, but I haven't pulled that up yet this morning.
Yeah, I noticed that housing starts had gone up, which that's a good sign for real estate. Hey, we're going to have more activity, and that's probably going to lead to more loans. I'm sure people are refinancing because we have lower rates. So that activity makes certain businesses more profitable. So that's all good.
Yeah, I did initiate a position in Pulte last week. They're a home builder.
Yeah. Yeah. Well, they might be doing well today. All right, good. So that's what's going on with the heat map. Looking at the companies that are going to announce today, we're going to look at Analog Devices. They announced before the market opened. Looks like Moody's also announced and Garmin announced, which is I'm going to call them a consumer device company. Booking is a stock that I think is going to announce good results after the market closes today. And the reason I say that is the airlines have been doing really well. Airbnb announced Thursday very good results. The general public consumers are traveling. They're spending money on travel. I know that sometimes like the media just constantly says, well, it's a K-shaped economy. You know, some people have money and they spend it, some people don't and they struggle. Well, the travel space and the the uh, um, the shipping stocks, or not shipping, but uh, the pleasure. You know, I think
Cruise
you're a
lines.
cruise lines. The cruise lines have been doing fantastic. So back to the economy. How are so many people traveling and there not being actual kind of either confidence or comfort in spending money? Because K-shaped economy, as economists would put it or not, that's a data point to me that means a lot. That means people are spending their money on something they don't have to spend on. Travel is pretty much an optional thing, right? Nobody's putting a gun to your head and saying you will get on this cruise ship and go have a great time in the Bahamas. No, you're like, hey, I want to go have a great time in the Bahamas. So you pay for your voyage and you're off to have a great time, or you get on an airplane and you go to that destination you want to go to and you spend some money. So that's all kind of it's giving me a sense that the economy's probably doing a little better than what's being reported. Maybe the data could be interpreted in a particular way. I get that, but that's telling me something else. Any thoughts on what I just said, Daryl?
Well, I know on the cruise lines, if you're flexible, you can get some. Not, yeah, you can get some really good deals on those. We typically go with Norwegian,
Mm-hmm.
and there's been times, as long as we're flexible, if you wait till like the last minute to book, they have empty spaces on the ship, and I don't know how they do it, but it's like $300 a person for a week
Jeez.
on a cruise ship. You can't go to a hotel for that hardly, plus all your meals and everything. So occasionally you can get some super deals on those cruise lines. So if
That
you
sounds
live
good.
near a port or you can get to a port pretty quickly, sometimes you can take advantage of those deals and cruise for almost nothing.
And they have internet on those ships, right? I've never been on a cruise.
They do have it. It's usually pretty slow. I haven't been on a cruise in since before the pandemic, so it's been a little while. But before that, I've been on 5 or 6, maybe 7,
Mm-hmm.
and the internet was pretty slow. I always took my own device with me, so when we were in port, I would have internet connection. But they may have put Starlink on these ships by now, so the internet may have gotten a little bit better. I do not know because I haven't been on one in 5 or 6 years.
Mm-hmm. Yeah, so we got one more data point on internet on cruise ships. Mike is saying last time I was on a cruise, you had to pay for slow internet. Yeah, I bet.
Yeah,
Yeah, I bet once they have you a little captive, right? They can sell you a few things and they keep a pretty good margin. All right, so I think Bookings is going to announce positive earnings. They've been doing well as a stock, so we'll see how that goes. Carvana, that's a stock that's really made a lot of news. They're going to announce after the market closes. DoorDash, and I heard a funny story about DoorDash. So, we got these Waymo cars that are robo taxis, and sometimes passengers don't close the doors properly, or they don't close the door at all. Well, it's a robo taxi. It can't close its own doors. So they have to call a DoorDash person who gets paid to go close the door.
oh my gosh.
Because they're working things out, which is okay. What do we do if a passenger leaves? Maybe they're on the phone and They leave and they leave the door open and they walk away. Okay, well, the car is just sitting there because it's not going to move. It's going to safely stay there until somebody closes it. So that's what they've had to do. DoorDash is comes to the rescue for them and closes the door. But I imagine that could get expensive if you're out in the middle of nowhere. And well, I don't think Waymos are, they don't service rural areas. They only service city areas. So nonetheless, I thought it was funny.
Yep, that is pretty funny. A failure in system design there.
Well, how do you design that into a robotaxi?
You could,
And
they have actuators that could close the doors. They just didn't think about that.
but then you have to think about, okay, you have an actuator. But what if a little kid is in the way and the robotaxi didn't see it? Boy, you got a pretty good lawsuit there. Or you
Yeah.
have a pet that is, slow to get out of the vehicle and it gets crushed. Oof, you got a pretty good situation there. So yeah, it's going to take a little bit of ingenuity there. I think they're going to think about that, as well as other things like it's Saturday night. Somebody had way too much to drink, and they had some really old sushi, and it doesn't end well in the back seat. Well, who cleans it? It's like, well, they're gonna have to take that car somewhere to get detailed, and that situation's got to happen more often than you would think. If you have a human driver, they're taking care of their vehicle, and if that happens, they immediately clean it. So you don't you have kind of like the immediate maintenance person in the driver when you have a human driver. I'm all for robotaxi, by the way. As you know, I'm a big investor in Google Alphabet, so not saying it's not going to work. Occidental is going to announce. Man, we got a lot of announcements today, and I'm an investor in Oxy. We'll see how they announce. So a lot of stuff going on. All right, so we're going to get started on Analog Devices. They announced today before the market opened. The market likes what they had to say, what they reported. 5% rise in the stock. And this company obviously has been going up because there's a lot of investment in data centers, and they're pulling in a lot of ADI's products. And it's up 57% over the 1 year. Over the 5 years, it's up 110%. So good investment for those investors that bought at the right time. It's become a $164 billion company. Forward P looks a little expensive. And man, the semiconductor space traditionally, historically, has been a cyclical industry. It goes up for a couple of years and it fades for a couple of years, and it just keeps doing that. On this occasion, it's gone up quite a bit, more than I've ever seen in my adult life. When's it going to ease up? It's going to ease up someday. Don't know if that's going to be in 2026. I don't think it's going to be in 2026. There's just too much. The big hyperscalers have said, hey, we're going to spend so much money on the data center. And that's kind of set for 2026. But 2027, will there be a slowdown? It could be. So you got to look out for that if you're in semiconductors. I'm certainly keeping an eye on that. These guys historically, and this is what I mean, right? Cyclical, slow down, pick up, slow down, pick up. And right now we're in one of those, growing years. Very good. This is the quarterly, and the quarter that was just announced, they went up 30% top line revenue. That's very good. Let's take a look at their profitability too. These companies, if they know there's excess demand, they've been taking advantage of that and increasing their margins. Look at that. Gross margin, 64.7. So they rose their prices so they could get a little more money from their customers. So that's good. It's resulted in a rise in profit. Margins are very, very good. So that looks excellent. Now, again, just reminding you that semiconductor is not going to be this great forever. If we think along those lines, I don't think we studied history enough to understand, hey, this business is good when it's good, and it slows down and stocks really sell off. The year we're in is this year that is going to end November 1st, 2026. They are growing nicely for the year, and the PE ratio is 33.5, moving to 29, moving to 25. It's expected they're going to keep growing. I'm not going to argue with that, but I would just say that there is a chance that there is somewhat of a slowdown or more competition comes into the picture. Earnings per share is going to expand nicely. So those numbers look fantastic. Looks really good overall. They have a good balance sheet. I'll go ahead and show my valuation. I did that while you guys were queuing into the live stream. And I think the stock's priced 26% too high. And the reason for it, mainly because the stock's gone up so much. And I'm using their trailing 12 months free cash flow, and I'm growing it by 10%, which matches what they're supposed to grow by. It's actually a little optimistic. I'm discounting by 8% because this space could see a slowdown. And I want to make sure I get a good discount rate, good rate of return. When I value the cash flows that I expect in this forecast and bring it down to a per share value, fair value, it's priced too high. It's 20% too high. And when I go to the valuation based on earnings per share, I give them an 18 PE. That's where semiconductor should be priced over a long period of time, in my opinion. I get a 39% premium on the stock. So this is a pass for me. I can get a better deal buying NVIDIA. I can get a better deal buying TSM. I get a better deal buying Astera Labs. And those are fantastic businesses, especially NVIDIA and TSM. So why buy analog devices? I'm taking a higher risk, and I don't have a whole lot of upside. I have some downside risk. So I personally am going to stay away from this stock. But let me kick it over to Daryl. He can take a look at the charts and see what he has to say.
So I was in the 1 year chart originally, and then started working my way back and got back looking at 20 years and found a 17-year trend channel. I do like companies that operate like this or perform like this. So basically, I've just connected as many lows as I could, made a copy and drug it up to the top, and connecting the tops, and then made another copy and just put it in the middle so we can see where the middle is. And they are trading at the high end of their channel at the moment. But over 17 years, this company has performed very, very well. So if we just go to the 1 year, we'll go back maybe 5 years. We can see traded at about this price, 220, for quite a while. Above it and below it at times, but now they've had kind of a level shift up to 238. Then we had a very brief point where they were trading around 277, and now they are skyrocketing. So we'll just go to the 1 year. They are trading and have been running right along their 5-day moving average. They came down and tested the 21-day moving average at the beginning of the year. That is upward sloping. They haven't tested the 50 days since the 25th of November. And I remember a lot of other companies selling off in October and November. This one did, but not to the same extent that many technology companies sold off. So they did test the 50, and they even tested the 200 back at the 20th of November. All of those are upward sloping, and they're in the right order. Did get a little bit overbought in November, came down and held the 60 line, held the 50 line at the beginning of the year, and then quickly recovered back to a level that is equal to what it was back in December. So that's a good sign. It's not a negative divergence. And this one's slightly lower, but on this particular charting platform, I'd have to go to the other charting platform for stock charts to be able to navigate into this and see how much lower that RSI is. But they're still holding right at that 70. And the PPO has been somewhat flat over the last 2 months, 6 weeks. Accumulation looks really good. We're basically at a just shy of a 52-week high, and the momentum or the money flow is in bullish territory. So this one's going higher today according to the pre-market numbers, and it looks like it's trading at all-time highs.
Thank you, sir. It is. I mean, semiconductors really flourished during a time when we've seen so many semiconductor companies do great. And we've had a couple people join. It is great to see everybody. Mike is looking at Cheesecake Factory. You can take a look at that. Fallsgrave noted that Zim is being acquired and the stock is up. Last time I looked, like 30%. Good to see you, Tomas. Peyton, great to see you. And looks like Tony is on. Good morning. Great to see you guys. So the Cheesecake Factory, they operate restaurants, and they haven't been in a Cheesecake Factory in a while. It looks like the brands they have out there: Cheesecake Factory, North Italia, Flower Child, Fox Restaurant Concepts. And all right. Now, restaurants are not my favorite, investment, but it is an investment that maybe others make a lot of money with. These guys pay a dividend. This stock is up 17% for the year, over the 5 year, up 25%. And boy, if you bought at the right time, you are sitting on really good gains. You doubled your money if you bought in 2023. So there is money to be made in these restaurants. Credit to Cheesecake Factory. They've continued to grow. That looks good. And their free cash flow is a little low. It's not very high. Their yield for free cash flow yield is 4.3%. Not very good. Profit margin 4.3%. Not fantastic. We just looked at a semiconductor stock, and boy, that really has good profit. So this one's got a little bit of lower profit. Looking at their forecast, we've got 15 analysts saying they are a little expensive. So this stock the company is expected to continue to grow. I think they're probably going to do that. They've proven that they can grow at these single digits, and they're going to continue to expand their profit. And on this stock here, I'll show a valuation after you get done with the charts, but why don't you take a look at Cake and see what or let us know what you're seeing.
Okay, so I do see a little bit of negative divergence here, so I'm going to mark that up. It's basically where the price is going higher, but the RSI is going lower, and I also see that same negative divergence on the PPO. On January the 12th, so we would have been about right here, we had a cup with handle pattern that triggered. So I created based on the depth of that cup and the price at the rim. Basically calculated a price target of 61.87, and on February the 5th, it actually hit that price target. February the 5th would have been right there, so it actually reached that price target, and it moved up another few dollars and now has rolled over, and the 5-day moving average is coming back down. The 21 days still increasing. We have a 50-day that's under the 200, but if these prices continue to stay above this 200, then we'll see the 50 cross above the 200, and that's known as a golden cross. It's a little hard to tell what the reaction will be when they announce their earnings. They do have an RSI of 60. The PPO is in bullish territory, but we are on a sell signal as of about the 11th of February. If we look at them on a weekly view, they also have an RSI of 60. We're on a buy signal in the weekly view, and I can see the black and red lines are getting a little closer together, as indicated by these histogram bars, which is basically the difference between those two lines. And the money flow has moved back into, well, according to this, it's actually still in bullish territory. Let's see where the accumulation, it has been higher. It's been in a little bit of distribution from July down to November, but we have seen accumulation since November back into this name. So it's a little hard to determine what the market is going to do once they announce.
It makes me think this is a stock you get in, you make your money and you get out. Might give up some of the gains, but I just don't see why it would continue to go higher. But that's how I see it from a high level.
Yeah.
Thanks, Daryl. So Tomas has got a quick question. Then we're going to move on to Zim and take a look at why that stock is flourishing and what's the state of the market. That's a good question. I want to answer it because I think the sell-off in some sectors and industries and moving into others, I would call it like the transition, and in some cases, I think there's a little bit of fear involved. It creates an opportunity to really look at some businesses that are really, really good businesses and buy them at a really good price. So I think it's an opportunity. I think it's a fantastic opportunity to pick up some shares in stocks that I was complaining 3, 4, 5 months ago were too expensive. So I think the state of the market is it's going to be a confusing year, and it's been a confusing year so far. And volatility is a good thing. If I do my homework and I find the businesses I want to own, it's a great time to buy. I've done that over and over again. And 2 years from now, I'll probably look back and say, most decisions I made in 2026, while things were really upside down and confusing and a little scary from time to time, ended up paying off for me. So those are my comments. Any comments you would add on to the state of the market at this time, Daryl?
It's definitely been interesting to watch the impact of what people are thinking about AI and how it's going to impact various companies. I know some companies are being re-rated very rapidly, and I keep hearing over and over that projecting in DCFs or whatever other methodology you use to evaluate, it's just harder to understand what those future flows are going to be. So a lot of people are just backing out at the moment and waiting to see when we get some clarity about how AI is either going to enhance some that are definitely going to get hurt.
Yeah.
It's just figuring out which ones are versus which ones probably will not be hurt.
Yeah. And so we're going to go through phases of how AI is going to change the business world and stocks. And right now, I can understand investors being on the sidelines after 3 terrific years, right? Like, hey, I've made all this money. Let me park some money on the sidelines and see how this thing sorts itself out. Got it. Um, I think specifically around software, some of these software names are going to prove that they're not going to be hurt by AI. And those stocks will do well going forward, especially if they accelerate their growth, expand their margins, which I think they have an opportunity to do so. If you had 100 developers working for your company 5 years ago, I think you could probably do twice as much with those developers now, or maybe not need as many developers, which reduces your cost of doing business, which increases your overall profitability. Why is that bad in any book? The brands of these companies and the stickiness is pretty darn strong. So I think some of these names are going to prove we're not being disrupted. And then that will, kind of be set up. Later on, over the next 5 years, we're going to have a new generation of software company come out that was born in the last 2 years. And they're going to come out with an experience for users that is going to put some of those software stocks on the defensive, because they may be like, hey, for example, yesterday I got a text message from TurboTax. I use TurboTax, and it said, hey, your taxes are ready. I go, whoa, I haven't even touched them. Okay. That's value add. Like, okay, I'm curious to go see how close they got, but my tax return is complicated. I doubt that they got it right, but I think it could save me some time. So that's good. Well, what if supply chain systems were like, hey, the new generation supply chain system, instead of you having people kind of update processes or steps in the supply chain, it does it automatically. It's constantly using machine learning and AI kind of agents to do that. And all of a sudden your supply chain is like, hey, I used to have 200 people administering this supply chain. Now I have 5. That's really good cost savings. And the software is probably very different. So that might put existing supply chain software companies on the defensive. Got it. That's going to happen like 5 years from now, once those products have matured and are ready for prime time. So we're going to see it evolve. Between now and then, fear is my friend. Volatility is my friend when I invest. It creates good pricing on stocks. And that's what I'm looking for, is entry prices into businesses that I want to be an owner of. So looking at the market high level, we're getting a lot of chat. Thanks, everybody. Good to see everybody's name. Appreciate you joining us on a Wednesday. Looks like NVIDIA is having a good day. Micron's having a good day. Palantir having a good day. Uber having a good day. Google, they decided to stop selling off for a day. That's good. They're having a terrific year, so I'm good with Google. The banking industry, look at that. They've been having a nice little rally this week. Citi was up like 2.7 yesterday. It's up 1.7 today. Amazon's up, decided to stop selling off. It had 9 consecutive days of selling off. And then we've got energy moving higher because oil prices are moved higher. So aerospace moving higher. Walmart's under some pressure. They announced on Thursday, big Walmart. And I don't know if they announced before or after the market closes, but that's a big one. They're almost $1 trillion market cap company. So a lot of people have bought the Walmart stock. All right, so Zim has moved much higher because it was announced that another company wants to buy them, and makes sense. They went from $22 a share up to $28.40 a share, and it's pretty much priced in that, hey, they're going to be acquired. I guess are they going to be acquired at $30 a share or so? And congratulations if you hold Zim. It's a stock that has paid big dividends. Look at this dividend, 15%. So if you held it for the last year, man, you are celebrating this week. You've been sitting on a stock that's paying you a huge dividend, and the dividend 15%, and now collectively over the 1 year, your stock has appreciated 41%. What's there not to like about that situation?
They agreed to acquire at $35 a share, so there's still some value left in that trade.
I wonder why there's such a difference.
That's a good question. Be worth
usually
investigating.
I mean, you get immediately priced at least 90% of what they're going to pay. I happen to be like on stocks that have been acquired that I own, I immediately take the gain and move on, because some things can happen that make the deal fall apart. It may take longer. That's just my style, but they're doing great. And Zim, when you price Zim, you get a discounted stock price. It's they did great during the pandemic. They went up to $84 per share because the shipping rates really went up, but then they really came down. And at one point they were paying a dividend that was like, literally, you would have been dividend your investment in the stock in 2 years. You would have been given back your investment in 2 years in dividends with Zim. And over the 1 year, successful stock. Congratulations to those that own it. Very good week in Zim. All right. Let me catch up on chat, and then we're going to move on to Genmab. So Peyton wants to look at CBRE. Glad to. And AI fears are causing it to sell off. Okay. Yeah. And CBRE, if I recall, is CB Richard Ellis, and they do a lot of commercial office buildings. They lease them out and they provide services there. So we'll take a look. All right. And then Ricardo wants to look at CoreWeave. Glad to. All right. So let's take a look at Genmab. This stock here is moving lower by 3%. They announced on the 17th, and I'm unsure if they announced before or after the market closed. Nonetheless, I can look at the 5-day.
They're a Dutch company, so they released it about 11 o'clock Eastern, so it was right in the middle of the day.
Okay. So market had time to process what they were looking. This stock is unique, highly profitable. I think they license out their patent that they've created, and somebody else manufactures it, and they package it, and then they distribute it and so forth. So they have this really high gross margin, and they have good profit, good free cash flow. The piece that might not be all that exciting is the growth. Although the growth is good, but look at this. This is what the market does not like. 3% growth in the quarter. That is the fly in the ointment. You have if they would have kept clicking at 20% growth, I mean, this stock's really priced not I mean, it can't go any lower and it makes so much darn money. It's highly discounted, but that is a concern there. When we look at their forecast, it's expected they're going to grow by 15%. So they just put up this number, which was a terrible number. They're supposed to rally back here in the quarter that's going to end March 31st. If they do that, then this stock should move higher. And from there, they're going to grow the quarters quite well. And when we look at the overall growth, they're going to grow for a couple of years. Profitability is going to really expand. Man, this is a good one. This is a very valuable business. And I'll kick it over to Daryl. Come back to it. The 1 year is doing great. It's selling off today, so it's giving you better pricing. 5 year, not so much. But it's about where you buy the stock and how high it's going to go from here. So let me kick it over to Daryl. I'm very curious to hear what he has to say on Genmab.
So I'm going to look at seasonality first, because this has helped form my getting in and getting out on this particular holding.
Daryl, are you there?
Performers.
Hey, Daryl.
Yes.
You're cutting out. It's cutting out for like a second or two at a time. Let's do another sound check. Please carry on. I'll let you know if it's coming through clearly now.
Okay. So we can see in January, February, and March, they are down each of those months over the last, let me slide that back over. Yeah, so this is for over seven years worth of data. They're down 6.5% in January on average, 1.1% in February, and 1.2% in March. So based on this information, I actually sold my holding on December the 31st, and I'm just waiting until we get back to their seasonally strong parts of the month. So now as we move to April, they are higher at the end of April than they began the month 67% of the time, and the average increase is 5.6%. May, they're up 3%, 50% of the time, and 0.6% in June. But then look at July, 100% of the time over the last 7 years, they've been higher than they began the month. And on average, they were up 7.2%. So I'm watching for an entry point at the end of or sometime in March to get back into this name.
And then you would sell what in August? Would you be selling in the next 12 months?
I probably would. It looks like they go through another period of time, at least for a couple of months. But then November is really strong once again. So I don't know if I would step in and out of it just based on seasonality. I did in December because I could see on the charts were supporting what I was seeing in the seasonality numbers as well. So now let's go to the charts. On December the 19th, I did calculate a price target of 36.64. It never quite reached close of 35.34, so it was just shy of this number. But then it started selling off. So when I sold on December the 31st, I mean, it immediately turned around and started working its way back up, and that looked like it was not a very good decision. However, it has been a good decision because today they're trading at 28.95. So they also have an RSI that is below 40, nearing the 30 line. And we've been on a sell signal since the 28th of January. And that doesn't seem to be losing any steam at the moment. So I'm going to continue to watch this one through February, maybe at the end of February or sometime in March. I'll pick it up depending on what I'm seeing on the charts. So I'm going to change this one annotation here because this green line should now be red. I think that they have broken. Well, maybe not. I'll leave that alone for a couple more days. They're trading below that today. But if it does this for a couple of days, then I'll change this to red to indicate that it's now resistance. So I don't know if the 200-day will come into play here, but they are trading below a downward sloping 50, a downward sloping 21. The 200-day is still moving higher, and they're only about 6% away from that. I don't know if they'll get to that. As the 200-day rises, they'll maybe come to meet each other somewhere around 28.19 or so. So if when it gets to that point, I'll probably pick up some shares and then hold them, as you pointed at least through maybe July or so.
All right. Thank you, sir. Let me take a look at my valuation of the stock. And Genmab's never been a question. It's discounted. It's just the market's not totally buying into the business. And as Daryl has showed, this stock has kind of a seasonality trend to it. So you can buy low and potentially sell high. It is discounted. This is a very profitable, high cash flow generating business. It seems like they own patents that are being used, and it's a pretty good business. Is this going to be a multi-bagger? I don't think so, but I think it could be a really nice performer, like 25% rate of appreciation in a year, if you enter at the right price and you exit at the right price. So that's my valuation on Genmab. Looks good. All right. Let's turn our attention to CB Richard Ellis. So these guys are in commercial real estate, a real estate investment trust. So the company operates through advisory services, building operations, project management, real estate investment segments. So they provide services. So if a business, let's say two things, a big owner of these buildings could use CB Richard Ellis to help them manage the property. But CB Richard Ellis is not the owner of the property. The AI threat is, well, if AI is going to do a lot of these human processes, like maybe a call center answering questions for customers or software developers that are typically going into an office and working. Well, if we're going to have fewer employees, that means businesses need or will need smaller footprints of office space. That's what is being priced into the market right now. So I understand the theory. Is it actually going to happen? I don't know. I think that, office space is going to be a necessity for many businesses, just to have the collaboration and people getting together. Maybe you have a client facing business, so you want to have office space so your clients can come visit you, that kind of thing. These guys over the 1 year, pretty much even. You're even with your money, but over the 5 year, you made money. I think part of it is that the compare coming out of COVID, and no, the COVID drop was pretty good, but man, it's up a lot since then. So it's been a good stock to own over 5 years. And let's take a look at more. $42 billion market cap, P ratio 19. So they're growing really well. 13% growth on a revenue number of $40 billion. The free cash flow is good, but not great. Gross margins are low. They're providing a service. So the owners of these properties are hiring this firm and either paying them a commission or, an amount to manage these buildings, but it's not a very high gross margin, which ends up being a low profit margin and a low free cash flow margin. So that's one of the limitations of this business is it just isn't a business that's going to make a lot of profit. All right, taking a look at their forecast. So looks like Peyton's got a comment. I think you're right. And that a lot of these businesses, right? Let's say you have a healthcare company and they provide healthcare, variety of things. You're not gonna reduce your footprint of real estate. You're gonna continue to see patients. They're gonna come in. You're gonna see them, and that's going to remain the same. There's a lot of industries where it's just not going to be affected. Will there be a couple of industries that are affected? Sure. Here's the other question: is does CB Richard Ellis have any involvement in data center real estate? And if they do, maybe that's going to be a catalyst for them to grow. So it could be positives and negatives as the market moves into the AI era. So analysts, 7 of them believe there is a discount available on this stock. They're pricing it using earnings per share. And the revenue growth does look good. They're growing at 13.7, 9, and 8.5. They are expanding their profit really nicely, bringing down their PE ratio. Now, the PE ratio on a business that has margins that CB Richard Ellis has, I don't like paying a high PE ratio. Just doesn't make any sense, right? Like, wait, why am I paying that kind of ratio? It's not like they're growing by 100%. So this here, I would want to keep it like 12 to know that I'm getting a good deal on the stock. And I wouldn't want to pay too much of a high dividend, PE ratio, excuse me. So I don't know that I have a valuation on CB Richard Ellis, but what we could do is we can let's take a look at the app that I've created. We'll put CB Richard Ellis. By the way, here's Cake. Did valuation on Cake, and I think it's priced too high. So let's take a look at CB Richard Ellis. The revenue is growing nicely, so their free cash flow is probably going to grow in proportion to their revenue. I'm going to put it at 9%. I'm going to go with a discount rate of 8%, terminal growth of 4%. When I value the stock based on the data that's available on Yahoo Finance for free cash flows, it's priced 33% too high. And when I value CB Richard Ellis using earnings per share, the growth was growing pretty fast. Let me take a look at it again on a screen you guys can't see, just to get reacquainted with what's supposed to happen on the earnings per share side. It's really expanding fast. So I'm going to go with 20%. And again, I'm going to go with the PE ratio at 12. It's my hard-earned money I'm investing here. It's not like, hey, I'm going to give them an overly optimistic valuation, and it's priced 51% too high. So the numbers just don't have a lot of intrinsic value in them. Low margins, low cash flows. The growth is okay, but not stupendous. So I personally would stay out of CB Richard Ellis. Been a good 5-year run for the stock. Whoever owns it, congratulations. But I would rather go look for a stock that has really good margins. That's going to really end up being a fantastic investment. And as we see the market operate this year, there are some businesses that historically have had these really high margins, high growth rates that are really well priced right now. They've been selling off. If you think the sell off in real estate's pretty harsh, look at software or look at Duolingo. Man, that stock's been sold off harshly. Uber has received some downward pressure because robotaxi is supposed to take over their business. So there's opportunities out there. I'd rather go explore and try to find the next multi-bagger in an industry that's really profitable. But thanks for the question, Peyton. Hopefully you found the analysis interesting. All right, let's move over to, it looks like Daryl's back. You there, Daryl?
Yes, I am. Thank you.
All right. So Daryl is clashing with the internet. I got my money on Daryl, by the way. All right, CoreWeave. This is a neo cloud company. And these guys, they IPO'd about a year ago. We're coming up on the anniversary of their IPO. They IPO'd March of 25, and they really went up. They IPO'd literally at the worst possible moment when we had that big tariff induced sell-off, and can't kind of hold it against them. Well, your stock didn't perform well for the first month because then it just took off. Holy smokes. Anybody who bought the stock was sitting pretty with a 4-bagger in a matter of a couple months. Since then, it's given up some of those gains, but overall, not a bad rate of appreciation over the 3-month. The 1 year looks great. What's going on with CoreWeave? The neo cloud companies and CoreWeave, if I have it right, they originally were a Bitcoin miner. And Bitcoin mining, you operate GPUs, you operate clusters of GPUs, and you use those GPUs to, within the Bitcoin ecosystem, validate a blockchain, and you get awarded, a piece of that Bitcoin, and you make money that way. Well, as the AI demand came into the picture, CoreWeave thought, hey, if we switch over to be a cloud infrastructure company with a specialization of running GPUs, we can make a lot of money. And I think they were right. I think it's a better market for them. And that's really the business. And they're a $47 billion market cap. They have been a company that's received good investment from NVIDIA because they use a lot of the NVIDIA GPUs. And overall, analysts think it's a buy. They don't have profit right now, but they are growing. And this is where the growth is at. Real fantastic growth. Okay, so I'm going to show you my valuation, which I've kind of had to use my forecasting and kind of use the experiences I have, because I do have experiences that give me a level of competence to evaluate the CoreWeave business. I'm going to show that to you in a bit. What I wanted to address is, let's take a look at their forecast. How are they going to grow going forward? So we have this fantastic growth in the current year. The growth next year is going to be really good, 58%, 46%, 39%, 29%. These growth numbers are really, really good. And eventually they are going to be profitable. In fact, they're going to be profitable next year. So that looks good. Looking at their margins, let's take a look at their margins. Gross margin 74%. That's good. They're not making money right now. It's okay because you're growing. They're buying a lot of GPUs. They're putting very expensive components into their data center operations. So I think there's a part of me believes if these guys make it, this is going to be a winning investment. But there are hazards. One of the hazards is if we have a quick slowdown, these guys are going to be in trouble. They carry some debt. Okay. And 18.81. They don't have EBITDA, so the EBITDA number is going to be really high. Actually, they do have EBITDA. So the EBITDA number is very high. So this is risky. If there's a slowdown, they have to make interest payments. If there's a real slowdown, like for 2 years, it's going to get really tight. It's going to be a scary situation. The stock's really going to get hammered. Those are the risks. What's the opportunity? If they hit this growth forecast and they keep flourishing, this stock's going to go higher. It's just the stock that, right now, judging from what the hyperscalers, the big cloud companies, AWS, Azure, Microsoft, Google Cloud, Meta, these guys are just expecting to spend massive amounts. So the timeliness of having this infrastructure available for you to build this AI business or this AI capability, if CoreWeave has capacity, they will sell it right now. It's just in high demand. So there's a lot of things that I like, but be aware. This one is, you're playing with a risky stock. You're investing in a risky stock. Speaking of risky stocks, let me kick it over to Daryl. He could look at CoreWeave. I don't know if it has enough history, but what do you have to say about CoreWeave, Daryl?
Well, since the last time we looked at it, we do have a 200-day that has started now. So, and it is rising. We noticed this downtrend the last time we were looking at this stock. We didn't have a 200-day to really confirm that off of, but we had this downtrend line, which they have come back and tested since we last looked at this. The 50-day had been declining since November. It stopped declining in the middle of January and is on a slow rise at the moment. The 5-day is rolled over, and the 21-day still looks to be increasing at the moment. And they're trading right at the 21-day moving average. The RSI is pretty much in neutral right now, just slightly above 50. This one's actually been on a sell signal since about the beginning of February. And one of the things that I notice here is it's been in distribution basically since June of last year. So I don't see that there are any big names moving into this particular company yet. We do see a little bit of accumulation over the last 2 weeks, but the money flow is still negative as well. So I don't really know about this one. You really have to believe in the business to step in. I think it could probably test that 50-day once more. So that's about $85 a share.
Thanks, Daryl. And looking at the CoreWeave valuation, and this valuation, I would say I'm being generous because they don't have free cash flow. But what I'm doing is I'm taking their cash from operations and saying, okay, they still have to put a lot of money back into the data center in the form of CapEx. So I'm going to take half of their, cash flow from operations and use that as a forecasting, base. And when I do that and I grow their cash flows by 50%, which is a very accelerated growth rate on these years, I only get to a stock price that is 28% below its current stock price. So not overly exciting there. And I'm using a higher discount rate and I'm not going to go any lower. I showed you the balance sheet. And on earnings per share, they're not going to make money this year. So I'm using next year's earnings per share, which is again pretty generous. PE ratio 25. If they're going to grow really fast and have good margins, go 25, which is again generous. And the growth rate of 50% can't get to the stock price. So for me, CoreWeave is a pass. And neo cloud stocks right now are interesting, by the way. If you look at probably Nebius and IREN have better valuations than CoreWeave. And I know I did a video on both of those recently, but I put those ahead of CoreWeave just based on valuations. And IREN, the thing I like about IREN is they have an advantage of they have their power source locked up. And it's right now, I think one of the necessities is electricity. IREN has that. So it's almost like they can sell the power and make a lot of money. They can use the power and operate their data centers. So they have, I think, better options and better profitability and better cash flow. So I'd put that one at the top of the stack with NeoClouds. Good question, Ricardo. Hopefully you found that interesting, sir. Ben 10 has made it to the stream. Good to see you.
By the
Ben
way,
10.
on CoreWeave, that $65 value per share you have on the far left, that has been tested 2 times, once in November and once in December.
Interesting. Well, let's take a look at, I think Enbridge, ENB. Enbridge, let's talk a little energy. They announced on the 13th, so last week, on Friday the 13th. Look at that. That's what happens when you announce on Friday the 13th. And FYI, I lived to tell about it. I flew on an airplane on Friday the 13th. If anybody's superstitious, you know what I mean. But these guys, they really sold off. What's going on? Why is this stock under pressure? It has been working for the 1 year, and for the 5 year, I mean, I don't think a lot of investors would complain if your stock is worth 48% more and you're paid more than 5% dividend per year. You look at the compounding of that dividend, you're maybe add 30% to this number, you're up 78%. That's pretty good. But what did the market not like? So taking a look at their growth and the way, and let me explain the Enbridge business first, or kind of get reacquainted. Enbridge, together with its subsidiaries, operates as an energy infrastructure company. The company operates through 4 segments: liquids, pipelines, gas transmission, gas distribution and storage, renewable power generation. The liquids pipeline segment operates pipelines and related terminals to transport, store, and export various grades of crude oil and other liquid hydrocarbons in Canada and the United States. Segment also provides physical commodity marketing and logistical services. So they're a midstream player within the energy complex. A necessity. They've been around for a long time. And taking a look at their market cap, 112 billion. PE ratio of 21, forward PE of 23. That dividend looks pretty good for investors that like. And the advantage of midstream players is if the oil price would really crash, it doesn't affect Enbridge as much. Now, on the opposite end, if oil prices really go up, it Enbridge doesn't participate in that so much. They kind of, play in the middle. They're less subjected to the commodity volatility. That's what their business is about. Their revenues in 2020, right? We were all asked to stay home and Zoom everywhere instead of drive everywhere. So less volume through the pipes. 23, less volume through the pipes. So positive. Quarterly, here's a quarter that was announced. And you see that's a light number, 6%. So I think that's a good part of why they probably sold off. And they had a bad quarter, Q3. So this is showing a slowdown. And there would be some homework involved here. Like I would go into their earnings and see what were the volumes? Did they drop? Was there some maintenance on a part of their operation? I mean, what's causing the slowdown? Maybe the higher oil prices are slowing down consumption. Is there also, here's a big picture threat is, okay, we got Venezuela now is going to be a source. It's going to be producing oil that's going to come to the States. It's going to end up coming in probably through Houston, through that network. And is that going to compete against Enbridge's pipelines? That's a big source of oil. Okay. Venezuela is the biggest holder of crude oil on the planet. Number one. Number two, Saudi Arabia. Venezuela does not produce a lot of oil because they haven't, like Saudi Arabia, has been all in on their oil industry and has had foreign investment help them develop their oil capacity. Venezuela needs to do that. And like 15, 20 years from now, they will be a wealthy country again. But right now they're not. For like the last 25 years, they've kept foreign investors from coming in and helping them develop their oil capacity. So as that oil capacity comes into the picture, that would be a big factor that is going to affect oil or at midstream players, I would say, because if it changes the source of the oil, it may leave Enbridge assets underutilized. Okay, so these guys are pretty steady Eddie. We need oil. Man, look at the drop in free cash flow. What's going on, Enbridge? What are you doing with all that cash? So forecast. So we're forecasting nothing exciting, a contracting year, slow growth year next year, contracting year the year after. So this is not exciting me. I don't really buy midstream stocks. I don't see, for the type of investing that I do, which is I'd rather have a stock that doubles every 5 years. That's my goal. I give myself an A grade if I hold a stock for 5 years and more than doubles. Okay. Mission accomplished. And midstream players, this one is doing well. They should not double every 5 years. They pay that dividend. That's good. Maybe as I get older, it's going to become more important to have dividends. But for now, it's just not my cup of tea. And I think this PE ratio is too high. I can get a lot of energy options for a better PE ratio. Let me kick it over to Daryl. Curious to see what Daryl's got to say on Enbridge.
Yeah, I was right in the middle of going to fast graphs on this one. Okay. So it's kind of what I expected, that they were going to be a little overvalued at this time. So they got their big boost with the AI deployment. So I can look at a lot of stocks like this. I can look at ETR and a few other companies that they all had a trigger right here and have all done very well. So I have a trend channel here. You can see that they've traded down below it. A lot of times just come down and test that lower end of the channel. Over this 2-year period, they've come up and tested the top end of the channel a few times, but it does tend to trade within that channel. On earnings date, they did pop out of the channel for 1 day, but now are back to declining. So it would not surprise me to, see the middle of this channel or maybe even all the way down to the bottom at some point, because that's been kind of what it does over the last 2 years. So now that we've seen that, I'm going to step into just a year. And they've been on a buy signal since the 16th of January. And that was confirmed by an RSI above 50. So that would have been a fantastic opportunity to pick it up. It wasn't too far from the bottom of the trend channel, definitely in the lower half. I also noticed that we're getting some higher prices, and that is being supported by the RSI. So you've seen me talk about negative bearish divergences quite frequently. This is not one. So we actually have a higher RSI than we did when it was trading at the top of the trend channel back here. We are starting to roll over on the 12-day moving average. It's leveling out just a bit. The stock has been under accumulation since, pretty heavy accumulation since the 8th of January. The money flow is positive at the moment. So if I were going to enter this one, I would wait a little bit. They are overpriced. I can go to ETR, which has done incredibly well for me. And they're just a plain old conventional electricity provider. They are also overextended. They just issued earnings, missed on, I can't remember whether it was revenue or earnings, but then they shot up, I don't know how many percent just in the last few days since they've done earnings. So they are very extended as well. Enbridge appears to be that way at the moment. So if you're going to trade this one, I wouldn't buy it at the top of the trend channel. The history is for it to come back down to better prices.
Speaking of which, the valuation of Enbridge I can't even get close. It's priced 68% too high. When I use the same methodology as I do on Chevron, Exxon, it's just priced too high. And I think the stock in a way is lower risk, but in a way it's just not going to go anywhere for me. So this is a complete pass for me. It's not the stock that I would buy. I do own energy, but I own the oil companies instead. So the stock market is having a good day, Daryl. Look at that. NASDAQ is up 1.17. Russell 1.24. S&P up 0.79. Looks fantastic out there. Look at that. Nice and green. That's the way it should be. We've got NVIDIA. Who needs analog devices? NVIDIA's making it happen. Palantir. Beautiful. Uber up nicely. Amazon. All right. Keep it going, Amazon. And Citi again. Citi's had a really nice two-day session. Looks like the energy companies are doing well. Exxon's up 2%. Chevron's up 1%. Materials are up higher. So it's a pretty good green day. Very, very nice. Palo Alto. I released a video to members, giving you my analysis on Palo Alto. Take a look. It's a short, so it's a little under 3 minutes. Give you everything you need on Palo Alto. Looks like the capital markets are doing well today. Very good. All right, let's check in on this contest we got going on, Daryl. Looks like Genetic Smite has got ALM material stock. Boy, that thing is just flying high. Look at that. Got Brian here with CCOI launching a challenge, I guess. Juicy with Nebius. And here's Daryl. And OKE, refresh my memory, what do they do?
They're a midstream pipeline.
Excellent. So there you go. Enbridge. Didn't look all that great, but look at OKE. Looking good. IREN, I talked about this one earlier when I was talking about CoreWeave. That's doing well. Oxy, Alibaba. This one is CPRX. Forgot. And that's where we're at. All right. So it looks like we're doing well. All right.
Let me show fast grass for OKE.
Yeah.
The only reason I picked this one for the contest is because it was down so much and I thought it could have a reversal play. But we just looked at Enbridge, we looked at ETR, and this one is at fair value or really close to fair value. So I thought that they were underpriced, and that's the reason I put it in the contest. I know I was asked about that one time. It wasn't that I expected to win, but I thought it could have a good reversal this year. So this one is not overpriced like some of the other ones, but still has an opportunity to participate in the behind the meter natural gas for these data centers. So I still think it has an opportunity to play in that space.
Thank you, sir. And while you have the screen, what's going on with your channel this week?
Okay, so the only thing I put out was my weekly review. It's a pretty long one, actually, of my holdings that have done pretty well. Really highlighting, I didn't move it over to, let me get out of here. Sorry about this. I wasn't prepared this morning.
No worries.
Let me. Okay.
Why don't we do this? I'm going to highlight a few things going on with my website, give you a few minutes. And then
okay, go ahead.
So, guys, just an update on my website. I've put a little more work into it. And each week you'll see more and more built out. And take a look. The super investor stuff is going to be updated starting in about a week, because there's some super investor activity that's pretty interesting. The believe it or not, Warren Buffett's selling out of Amazon, which I heard, and I'm a little surprised. He usually sticks to a position longer, but maybe Warren Buffett's becoming a day trader before our own eyes. But I'm going to update this guy and give you the performance of their portfolios if we just measure the 1 year performance on those positions. And we'll do that at the end of February, see where they stack up. In the meantime, I'm going to be updating their portfolios as they announce their 13F filings, and we'll go from there. Looking at this is going to be the permanent website, just to give you a sense of what's going to happen. This is going to be the permanent website, and there'll be a paid member portion to it, and there'll be a free portion to it. This landing page will be free. It really explains my methodology and gives you certain videos and assets that align with each piece to it. You can check in on the contest on the website. and see where everybody's stacking up. Looks like, man, ALM's even higher. Geez, that stock's just booming. I started a blog this weekend, so I'm going to be sharing up to date, either comments on a stock like Palo Alto. I created a video, and here are some highlights from that video, as well as, here's a video on the Chinese stocks and how they've been outperforming, Coinbase, as well as other things. So that's where my blog's going to be. And that's going to eventually automatically update Discord as well as other links. In here, if you become a paid member, the first month is free. You can access these tools. And the tools enable you to put in a ticker and then change the rate of growth that you expect for the first 4 years. The terminal value is always going to be set to, or actually you control the terminal value growth. So you establish your growth for the first 4 years, and then your terminal value growth. You can put in your rate of discount that you want to go with, and it'll value it based on discounted free cash flows. It pulls the data from Yahoo Finance. So we want to make this easy, simple, and the same thing for earnings per share. If you are dealing with like a bank, you would just go with earnings per share and then value it using that tool. You could also do just discounted free cash flows, but you can open up both of them with this screen. Looking at company moat, this is I think I really like looking at company moat when we have industries that are really sold off, because it reminds me of, what am I looking for? I'm looking for great businesses that land in the green. And if I'm getting really good discounts, I'll hold that stock for a couple of years because it's a great business. And eventually the market will realize that and price it to intrinsic value or higher. So that is behind the paid member wall. And I'm going to add some other things. Eventually, all the things around my portfolio and other things are going to be added to the paid portion of the website. So take a look if you have some time. Now let me kick it over to Daryl.
Yeah, so I put out these weekly videos where I highlight charts and any trade decisions that I made based on the charts. Hopefully for those that want to build their technical analysis skills, these are helpful. And then I also put out shorts for companies that are reporting in a particular week. So Genmab, I put out their earnings review, and this is where I cover what's the implied move, are they showing relative strength, what's the price trend, and these are just a minute long, so it gives you quite a bit of information on those companies that'll be reporting this week.
All right. Thanks, Daryl.
All right.
All right. So, guys, that's it for the live stream for today. And it looks like if Daryl's up for it, we can stream again on Friday. Between now and then, good luck with your investing. Thanks for tuning in, and we'll catch you on the next live stream.
Take care, everyone.